lose money. Next that I'm going to talk about is the strategies that you use to trade. Now, how do I know when to buy, when to sell? And to begin with this, I need to teach you two things. That is, one is invest and the other is trade. So there's a huge difference between, hey, this pen. There's a huge difference between both of them. So what's the difference? So when you're an investor, you're trying to make long-term accumulations. Basically, you're trying to, buy it today in an anticipation to sell it after 10 years. To give an example and to make you regret, there are companies where the share price were 20 rupees, 30 rupees, 200, 300 rupees back in 2003, 2004. And today, those same companies are worth thousands of rupees. MRF, for example, was around 100 or 120 rupees in the 90s, and now it is around 70, 80,000. In fact, at one point of time, it was trading at 90 plus. So, the amount of percentage of capital gains you're going to get. So this is about investing. And for investing, you need to choose the right company, and it's not a complete inflow always. It's one investment in one boat, expecting that boat not to sink after many years. So I don't believe in a very long-term investing until I find the right company. And the other way of investing is, of course, the trading. So what's trading? Trading is basically holding a stock in a short term. Short term can be 1 week, 2 weeks, 1 day, 2 day, 3 days, 4 days, 5 days, or 3 months, anything within a year. So you get a news, you try to take advantage of it. It's called trading. Take advantage of it, and before a bad news comes, sell it. Now, investing, to give an example, I invest at 100 rupees today, and after 10 years, I sell it at 1,000 rupees. I'm really sorry for the pen, 1,000 rupees. So the 100%, I mean, the increase which is basically your 900 by 100 or 9,000%, is over a span of 10 years. And in between, you're not going to get any money. Only when you sell after 10 years, you get money. Now, what is the advantage of trading is that I buy at 100 today. After 2 days, I sell at 150. Again, this 150, some bad news will come. It'll go to 130. I'll buy that time again. I'll sell this time at 170. So I got 40 rupees here. I got 40 rupees here. So 80 rupees I got in span of 2 weeks. Simple. 2 weeks, 3 weeks. Now this 80 rupees is for one share. If I multiply it with say 100 shares, I got 80,000. I mean 8,000 in 2 weeks. Right, 8,000 in 2 weeks is enough for a pocket money for a month, I suppose. For at least for me, it's enough. So yeah, let's not get into that. But what I'm trying to say is trading gives you a continuous inflow of cash, and investing is a security over the long term. But again, you can't say 100% safe. It is to invest because there are companies like Yes Bank, DHFL, DLF, Reliance Power, Reliance Infrastructure, Reliance Communications, and a lot more to add to that. So all these companies have just given you the best hopes, the best colors, and they've dropped. I'm going to teach you even about investing, so don't worry. I'm going to be there with you guys. Okay, so we have completed two things right now. One is what's a blue chip, which are the stocks I'm going to start with as a beginner. What am I going to do with them? Invest or trade? And what are these 50 stocks? I'm going to run through them pretty soon. And I also told you what are the sources of information where you need to read. That's the 4 apps which I gave you about. I'm going to even take you through money control because it looks pretty complex for a beginner. Now, the next thing is I have some other strategies. So I'm just thinking if I need to take you through the company first or the strategies first. Okay, I'll explain two strategies and then I'll take you to companies, how to read the companies and all that, and then I'll come back to strategies. Now, let me just clear this up. The first strategy that I want to talk about is averaging out. So this is useful for a trader more than an investor. So let me write it down. Averaging out. Now, I hope you understood, because to explain, I might need to clear this, so it wasn't worth writing. Never mind. Now, what exactly is averaging out? So say today, as on 15th, I bought a share at 100 rupees. As on 18th, the share price went to 120. I might have wanted to sell it, but I didn't sell it because lalach, of course. That needs to be there in stock market. You're going to be great. You're going to fall down. You're going to learn on your own. That's not something that I can teach. It's not something that patience, lalach, I can't stop all of it. So yeah, now you didn't sell it on 18th. Now either between 100 to 120 in the 3 days, it rose because it rose 20% because of reason, which was very strong. Say it made a deal. It made a deal of, say, a contract with an infrastructure company like DSFL, or let me not take DSFL, it's not in good books now. Say Shobha or Brigade or JMR Infra. Say they bought a deal of constructing an airport of, say, 5,000 crores. So that's a huge deal. They're going to get a huge profit from that. So that is why this profit is going to come over the years. It's going to come as and when they finish the stage, they're going to get paid, the profit gets recognized. So the profit's going to come over so many quarters, and it's a strong news, right? So you know that this news is going to impact over a long term. Now, what happens is after these 3 days, from 18th, you hold it thinking, Acha, TK, we can hold it for more time because the news is very good. But the price suddenly goes to 80 rupees. Why does it go to 80 rupees? Because it's a bullish market. What's a bullish market? A bullish market is where everybody's selling. So this is the graph. The market has been going up. People feel that this is the height. They'll sell. The market will go down. People feel this is the low. They'll buy. It will go here. People feel this is the high. They'll sell. It will go here. So this is your market. You need to understand these separate cycles. The day you understand these cycles, nobody can stop. And that will take you at least 2 or 3 years experience. So even I'm not completely over there, but I'm learning. Each month you might have a cycle. You might have a cycle once in 2 months. You might have a cycle. Yeah, once in 2 months at least you will have a cycle. That's called correction of market. So market goes here, it corrects itself, it comes down, then it feels it's corrected a lot. It should have stopped here, but it's come to here. So then people will buy, but then there'll be a little problem here because the market won't go up also, it won't go down also. You stay here for a while. After staying here for a while, people will realize that this is the bottom. It can't go below this because it's not going below this. So we'll buy more. So the buying more starts. Demand increases, supply decreases, price increases. That's how your stock market works. But again, deviating, coming back to the topic example I was giving you, what's averaging out. Now it's 80 rupees. But the news is strong. The news is in the long term is very strong. But abhi ke liye it's come to 80 rupees because of the bullish market. So here I'll buy more. I'll not panic sell. Many of them sell, okay, but don't sell. Buy more. Say you had 50 shares at 100 rupees, buy another 50 shares here. You buy how many you want. I'm just saying. So this will give you 5,000, and I hope this will give you 4,000. And if you total, uh, if you're going to total this, you're going to get 9,000, right? 9,000 is going to be a total investment as on say 21, 21st. Now, you understood this right about making your investment more, and now it's 9,000. And I told you about 50 shares that time, you bought 50 shares next time. Now your total investment is 9,000. Total number of shares is 100. So the cost price per share is 90. So initially it was 100 cost price, then it became 80. Together it became 90. Now the advantage of having your cost price at 90 is that one or the other day the market has to correct. I told that a reasonable price for the share is 100 rupees because it was trading at 100 rupees for a long time. but it was worth 120 rupees because of the deal. It came down because of the market condition to 80. Now you have the stock at 90 rupees, not at 100. Initially you bought it at 100, but now you have it 90. One or the other day it has to go back to 120. So it goes to 120. Here also it goes to 120. Here you got 20% profit. Here you got 33.33% profit. So whenever you get a chance to average out, you can do this. And the whole concept of averaging out applies to a company which follows two conditions. First thing, it has to be a blue chip. Please, it has to be a blue chip. Second thing, there should be a strong good news in the next 1 or 2 years. If these two companies are going to be fulfilled, even if the price is going to fall, buy more, keep buying, keep buying, keep buying. Keep buying, keep reducing your average cost, keep reducing your average cost. Whenever the day it will increase and the profits will increase. That's one strategy everybody should know. The second thing that I'm going to explain is basically what I call as swing trading. I'm not sure if that's what it is called, but I call it swing trading. So this comes only with a bit of market sense. It's not something I can teach you in detail, but you need a lot of market sense for this. So imagine there's a graph of Nifty 50, the index. Okay. So now as of today, as I told you, the market goes here, not so high, but the market is increasing and it goes to the top. Oh, what's wrong with this? Just give me a second to correct it. Yeah, so the market is increasing, go stop here. So people in 15 days, they become so much rich. Whoever has understood the market properly, in 15 days, if he would have judged that this is the low, he would have bought means in 15 days, he can sell it here. But nobody gets to know. To be very honest, nobody gets to know. Only if you're very experienced, you will know it. And at this point, you are sure that it's pricey. When you're sure that it's pricey, you sell it off. Again, the market will fall here, then buy it here. Then again, the market will go here, then sell here. Then again, the market will fall, then buy. Then again, it will go here, then sell. This is applicable to all stocks, not only your Nifty stocks, but applicable to all stocks. Now, how do I guess that the market is going up, the market is going down? It only comes with market sense. Well, if you're into the market on an everyday basis, you will know that, acha, 2,200 rupees for Reliance is expensive, 1,900 rupees for Reliance is cheap. So you will know all of this only if you're into the market for a very good amount of time. So these are my two strategies.